Have you ever wondered why you always seem to buy at the top and sell at the bottom? Not just once, not just by bad luck, but almost every single time? Welcome to Growth Wealth Code, where we explain investing concepts in a simple way. In this video, we're going to talk about the psychology behind market timing, why your brain is basically wired to make bad investing decisions, a few real stories from history that prove this pattern repeats itself generation after generation, and most importantly, what you can actually do about it. But first of all, this video does not contain any financial advice. Everything here is for educational purposes only. What you do with your money is entirely up to you, your goals, and your risk profile. So let's start with the problem. If you've ever felt panic when the market drops, or felt that itch to jump into a stock because everyone is talking about it, you're not broken. You're not undisciplined. You're human. And that's exactly the problem. Let's break it down. Imagine you're at a birthday party. Everyone brought a little bit of money to chip in for the cake, the decorations, the music. Nobody put in all the money themselves, and nobody's individual contribution decides whether the party happens or not. That's basically what a fund is, a group of people pooling their money together so that no single person carries all the risk, and everyone shares in the outcome, good or bad. Now here's the thing. Even if you're part of that birthday party of investors, holding a nice diversified fund, your brain still doesn't behave rationally when the music stops and the room suddenly feels tense. And that's what we need to talk about. Here's the truth. Our brains were not built for the stock market. They were built for survival on the Savanna, tens of thousands of years ago. Back then, if you heard a rustle in the bushes, the smart move was to run first and ask questions later. The cost of a false alarm was low. You wasted a little energy running. But the cost of ignoring a real threat was your life. So evolution wired us with a very simple rule. When something feels dangerous, react immediately. Don't wait to analyze. The problem is, that same wiring gets triggered when we see red numbers on our portfolio screen. Your brain doesn't know the difference between a lion is chasing me and my portfolio is down 8% this week. It just knows. Danger. Danger. Get out. This is called loss aversion, a concept studied extensively by psychologists Daniel Kahneman and Amos Tversky. Their research found that the pain of losing money feels roughly twice as intense as the pleasure of gaining the same amount. So when your portfolio drops 10%, it doesn't just feel bad. It feels almost twice as bad as how good it felt when it went up 10%. That's not weakness. That's just how the human brain is calibrated. So what does that actually mean for your investing decisions? It means that during a downturn, your brain is screaming louder than usual, telling you to do something, anything, to make the pain stop. And selling feels like doing something, even if mathematically doing nothing is the better choice. Let's look at a story to make this concrete. Meet Panicky Pete and Steady Sarah. Both of them invested the exact same amount, $10,000, into the same S&P 500 index fund back in January 2020. Then came COVID. By March 2020, the market had dropped more than 30% in just a few weeks. Panicky Pete couldn't take it anymore. Every day he watched the news, watched his portfolio bleed red, and finally, in late March, he sold everything. He locked in his losses and moved to cash, telling himself he'd get back in when things calmed down. Steady Sarah, on the other hand, didn't check her portfolio every day. She had already decided, before the crash even happened, that she was investing for the next 20 years, not the next 20 days. So she did nothing. She just kept contributing her regular monthly amount, even when it felt uncomfortable. Here's what happened next. The market bottomed out in late March 2020, then staged one of the fastest recoveries in history. By August 2020, the S&P 500 had fully recovered. By the end of 2021, it was up more than 40% from the pre-crash high. Panicky Pete, who sold in fear, eventually got back in, but much later at higher prices, after most of the recovery had already happened. Steady Sarah's $10,000, left untouched and even added to, was worth significantly more by the end of that same period. Same starting point. Same amount of money. Same crisis. Completely different outcomes. Not because Sarah was smarter than Pete, simply because she didn't let her brain's ancient alarm system make her financial decisions for her. Now, this isn't just a COVID story. We've seen this exact pattern before. During the dot-com bubble in the early 2000s, investors pile into tech stocks purely because prices were going up. A behavior known as herd mentality, the instinct to do what everyone else is doing because it feels safer than being the odd one out. When the bubble burst, a lot of those same investors sold at the bottom, terrified, only to watch the market recover over the following years. We saw it again in 2008, during the financial crisis. Fear was everywhere. Headlines were screaming about the end of the financial system as we know it. Many investors sold everything near the bottom in early 2009, which, in hindsight, turned out to be one of the best buying opportunities in modern market history. So why does this keep happening? Over and over, generation after generation, even though we supposedly know better now? Because it's not a knowledge problem. It's a wiring problem. You can know, intellectually, that markets recover over time. But when your portfolio is down and the news is screaming, that ancient part of your brain doesn't care about your intellectual knowledge. It just wants the pain to stop. There's another bias working against you too, called recency bias. This is our tendency to believe that whatever is happening right now will keep happening. When the market is crashing, it feels like it will crash forever. When the market is soaring, it feels like it will soar forever. Neither is true, but in the moment, it always feels true. So here's the catch. If our brains are naturally wired against us, how do we actually protect ourselves? The answer isn't to try to force yourself to feel differently when the market drops. You can't out-willpower millions of years of evolution. The answer is to build a system that doesn't rely on willpower in the first place. This is where dollar-cost averaging comes in, investing a fixed amount on a fixed schedule, regardless of what the market is doing. When you automate your investing, you remove the moment of decision entirely. There's no daily choice of should I buy today or wait, because the decision was already made in advance. Back when you were calm and rational, not in the middle of a panic. The second part of the system is having a clear, written down reason for why you're investing in the first place, and for how long. If your money is meant for a goal 15 or 20 years away, a 30% drop this year is, statistically, just noise along the way. But if you don't have that time frame clearly defined, every dip feels like an emergency, because you have no context to measure it against. The third part is simply limiting how often you check your portfolio. This sounds almost too simple, but there's real behavioral research behind it. The more frequently you check your investments, the more emotional reactions you expose yourself to, and the more likely you are to make an impulsive decision. Checking daily is checking for pain. Checking quarterly or even annually keeps you focused on the bigger picture. Now, I'm not saying emotions don't matter, or that you should ignore how you feel about your money. I'm just pointing out that when it comes to buying and selling decisions specifically, your gut feeling in the moment is usually the least reliable guide you have got. It's not about timing the market. It's about time in the market. That's not just a catchy phrase. It's backed by decades of data. Missing just the 10 best trading days over a 20-year period can cut your total returns dramatically. And here's the tricky part. Those best days almost always happen right after the worst days. When fear is at its peak and it feels least safe to be invested. So where does that leave us? It leaves us with a simple, if slightly humbling, conclusion. You are not going to outthink your own brain in the middle of a crisis. Nobody can. The goal isn't to become a fearless, emotionless investing robot. The goal is to build habits and systems in advance, during calm moments, so that when the fear inevitably comes, you don't have to rely on willpower at all, of course. Everyone's situation is different. Your timeline, your risk tolerance, and your financial goals all play a role in how you should structure your investments. This isn't a one-size-fits-all answer. It depends on your goals and your risk profile. If you found this helpful, hit like and subscribe to Growth Wealth Code. And if you like this video, you'll probably like our video on dollar cost averaging versus buying the dip, where we walk through exactly how these two strategies play out with real numbers. See you in the next one.